Welcome to SilverOak's quarterly webinar. My name is Shannon King, and I'm President, Partner, and Chief Compliance Officer of SilverOak. And with me today, as usual, is Jonathan Charlo. He is also a partner of the firm and our lead analyst. In today's webinar, we're going to spend about 45 to 60 minutes discussing the markets and the economy and going through our outlook. If you have any questions throughout the webinar, please feel free to contact your SilverOak advisor after the session ends. Or if you're not currently working with a SilverOak advisor, feel free to contact me directly at 952-896-5701. And I want to thank Jonathan, you, and the rest of the team, everyone that's involved in putting this material together. I know it takes a lot of effort to gather all the information and even to just coordinate from a technology perspective. So thank you everybody for putting it together and making it possible, and thank you for everybody that's listening in and watching. For compliance purposes, I do need to note that we'll be discussing the overall markets and economy during this webinar. In doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Also, we will not be discussing specific SilverOak portfolio performance, as each of our clients' portfolios are customized. Nonetheless, all of our clients should have received their customized performance reports here within the last week or so. If you have any specific questions, feel free to contact your SilverOak advisor if they haven't already contacted you. And of course, since I'm compliance officer, the last disclosure is past performance is no guarantee of future success. So with that, Jonathan, let's take a look at the agenda. As I had mentioned briefly, we'll talk about the economy and go through SilverOak's dashboard. We'll touch on market performance, particularly for the first quarter. We'll go through SilverOak's outlook for the remainder of the year and beyond. And then we always like to touch on a topic that's different each webinar. In this particular case, our topic for today is financial planning for incapacity. So for those who may be facing situations where a loved one has dementia or Alzheimer's or some other situation in which they've just either are losing their capacity or simply have lost it already. So we'll talk about the important components of planning for that, both before and during those situations. We'll also provide a SilverOak update with regards to some exciting things that are happening here. And of course, as I mentioned, any questions can be directed to SilverOak via your advisor, or you can contact me directly. So with that, let's talk about the economy, Jonathan, and let's take our first look here at the dashboard. For those who may be new to our dashboard, we have 5 major components that we measure in the dashboard, each one having subcomponents thereof. And here we can see for the economy, we're basically saying that the economy in Q1 of 2026, which is circled, was positive. Green is positive, gray is pretty much neutral. If you see a red, that's typically signs of negative, like not necessarily good. And then there's various shades of those. So Jonathan, here we're saying the economy this quarter is good, and I guess
we've seen an improvement. And we'll certainly talk about one area in the components on the next slide where we've definitely seen improvement.
Perfect. Yeah, and that particular component has 24 subcomponents. So there's a lot of different factors that go into that data point. Let's see. There we go. Credit markets. Credit markets are also positive after having come out of neutral a quarter or two ago. So that's encouraging to see, and we'll talk more about that as well. And by the way, the credit markets, that has 7 sub-factors to it. But valuations, they haven't changed much. I guess there was a little glimmer that maybe valuation, well, I want to say glimmer, but valuations were looking less high maybe a week or 2 or 3 ago. But that's simply not the case for good or for bad. And then the next component is market sentiment. And that remains quite positive, although we have that shifting down just slightly over the next couple of quarters. Is there a particular catalyst to that?
I don't think there has been necessarily a big issue, but with having the market come down, I think that had a little bit of a shift in terms of our outlook. But then again, with what's happened even in the last week, that might have changed again. So it might be more solid for the second
And I know
quarter.
some components of this are consumer sentiment.
Right.
And, those can be quite volatile, quite reactionary, and frankly, quite negatively correlated to markets.
Right. We've talked about how consumer sentiment, many times the best returns come after hitting a low point.
Exactly. Well, if we bring this all together into the last item here, and that's the composite. So we take those components and we put together a composite based on those components. We're still in the kind of neutral range on our overall composite, which you'll see on a chart in the next slide. But we are forecasting that that's going to turn a little bit more positive and at least in the right direction here shortly. So if we look at the actual chart, and we'll see that we're kind of in that upper range of the neutral section of the composite. But as like we look to the further right, we're going to see that that trajectory, as I mentioned, is on the upward slope. So no signs that it's going to be pulling back. With that, let's go into one of the subcomponents of the economy, the ISM.
And this is where we've seen some big improvements. So if you look at the far right on the slide, you'll see the black and then the blue. And so the black line represents the ISM manufacturing index, which was below 50 for a number of years. But in the last quarter, we actually saw an uptick in the manufacturing ISM index. So I think that really points to some overall strength in parts of the economy that had been a bit weaker. And then the blue really is the consumer-based part of the ISM, and that also in the last quarter has seen a nice upshift. Now, it did come down a little bit in the last month, but is generally very positive.
And then unemployment.
Yeah, and so if we look on the bottom half of the slide, while it has been ticking up from a bottom right near 3.5 in the last quarter or two, it's actually come down a little bit and sits at 4.3 currently. Housing starts is a part of the economy that did see an initial improvement coming out of the pandemic, but has really been stuck at lower levels, and that's somewhat interest level based. We've definitely seen mortgage rates come down from their peaks, but they've really been kind of stuck in the last year at levels that are helpful, but not necessarily low enough yet to spur a lot of activity.
So the theory is rates come down further, we might start seeing some improvements here.
Correct.
Which we'll talk about in a few minutes as far as whether the Fed is likely to lower rates or not.
And here we have tracked inversion in the yield curve, and that's when it has a negative slope, meaning that shorter term rates are higher than longer term rates. That has flipped in the last year, and we did not see a lot of changes necessarily to interest rates in the quarter, nor a big change in terms of the spread between different types of maturities.
Which, talking about spreads, this next slide touches on spreads. And I guess before we touch on spreads, why do we really even care about spreads?
Well, I think it kind of gives you an early indicator of what could happen in the economy, meaning that if credit markets, the spreads widen, meaning yields on, say, corporate bonds become higher relative to treasury bonds, that's telling you that there might be some stress in the underlying economy, and people are looking ahead towards that. And what you can see is that, sure, in the quarter, they did tick up a little bit, but certainly are not at levels that are concerning, nor at levels we've seen in the past that where we did see more stress.
Got it. Well, let's move on to valuation. So we talked about a couple of the subcomponents of the economy. We talked about one of the subcomponents or two of the credit for the dashboard. Now let's transition to valuations, because as we saw on the dashboard, we said valuations are kind of in the negative, like they've been red for a while. Yet here, one of the subcomponents of valuations, corporate earnings, looks good.
Yeah, in fact, we had good earnings growth last year. The projections for this year are even a little bit higher than last year, as well as good estimates for next year. We'll go through it in greater detail on another slide, but certainly corporate earnings growth is helping the market. We have just seen very strong performance, which again adds to that higher valuation.
Got it. And the last one is, as far as a component of the dashboard, we have sentiment and market, in this case, market trend data.
Yeah, and so we did have a pullback in the first quarter, specifically in the month of March. We talk about it a little bit later, but we have seen a snapback in the market. And so the bullish uptrend that we've seen in the S&P 500 seems intact.
Yeah. All right, so I know that was a rather quick synopsis of our market dashboard and the economy, but nonetheless, hopefully it gives you a good oversight. We tried to touch on the most important components, and frankly, you and I, as we were talking about preparation for today, there really hasn't been a ton of change quarter over quarter in many of these indicators. But there's been a lot more volatility in the markets. So if we look at market performance, we can see Q1 was pretty mixed. Certain areas of the market were positive. U.S. small cap stocks in particular did quite well, while U.S. large cap didn't fare nearly as well. If we look here, though, on a one-year basis, still double-digit returns across the board. And that is really the product of last year just being so strong across most of these, if not all these sectors. On the next page, we'll see the bond performance. So again, Q1 was kind of mixed. I mean, bonds were a break even or so. Commodities obviously strong, and real estate actually did quite well. And if we look at the one-year numbers again, at least for bonds, they're much more respectable numbers when we start adding in the last couple of quarters of 2025, which, you know, for people that maybe weren't on our year-end review, 25 was a great year pretty much across the board, equities, but also within bonds. And we're seeing some of that here. Tell us though about style, like within, say, large cap US or large caps or US small cap, which did better? Value, which tend to be more like quasi older economy, bank, financials, or growth, which tends to be a little bit more technology oriented?
So interestingly, in the first quarter, we did see value do better, and we were seeing kind of a broadening among different industry groups that were performing. And so in the quarter, large cap value was actually up a little bit in large caps versus growth that was down. And that trend that we saw also was evident in mid caps and small caps.
And you say surprisingly only because the last couple of quarters, well, the last couple of years,
Right.
frankly, growth has dominated.
Right, because of technology and people, the term Mag 7, many people know about, and that's really because of the strength in those top tech stocks.
Got it. As far as sectors go, and you kind of already touched a little bit on it, what did we see? And I guess here it's pretty evident, with the financials.
Yeah, financials were down within value, but everything else was up. Whereas if you look in the growth category, pretty much everything was down from an industry standpoint.
Got it.
And again, very different when we look at the year. And so you'll see, looking down at growth, that communication services and technology, basically up roughly 30%. Energy was really the only category where we saw such strength in that past year, but it was all because of last quarter.
Yes,
So
that's a good point.
So a lot of other value categories did fairly well. I would really highlight industrials, and we were talking about the fact that manufacturing was picking up, and I think we're definitely seeing that in the stock prices for industrial companies.
So all of this thus far has been predicated around the U.S. markets, and this particular slide is the S&P 500. Talk us through the international markets.
International did slightly better than, say, U.S. large cap, but it was a quarter where we generally saw international markets down. Now, Latin America is one that stood out, that was positive, but really a couple of areas did well in value, and I mentioned energy, but also materials. And so that dominates the Latin American index, hence the positive performance.
And the exceptionally positive performance on a one-year basis.
Correct. Yes, absolutely. And again, in general, we saw stronger international performance last year, and that's kind of carried it over. We've talked about earnings growth getting better internationally, some fiscal stimulus in Europe, but also we've talked about just how the dollar has come down a bit, and that's provided a tailwind.
Well, that was certainly the case in 25. I mean, there was a large component of those international returns associated just simply with the currency conversion. I think this year it's been a little bit more mixed. The dollar was up a little in the first quarter. I think it's now back to about break even on a year-to-date basis. Last year was super weak, which helped with those returns.
Absolutely.
Which was kind of nice because honestly, it's been several years since international has really outperformed the U.S. And I know a lot of people were questioning, should they even own international? I think we've talked about it in the past year or two, but we stuck with it, and finally last year it did pay off.
Yeah. So talking about bond returns, we showed on a one-year basis still positive returns. Now in the quarter, we did certainly see returns negative in most of the categories. So emerging markets down the most, and again, that was a bit more tied to what's been going on globally. We mentioned that high yield spreads actually widened a little bit, hence the slightly negative performance. And then if we go all the way to the right, tips were actually one of the categories that was up, and that was a little bit because of inflation. But as we mentioned, the one-year returns are very, very solid across most categories. We've talked about how bond returns are typically the yield plus any changes in the underlying price. And so we did see interest rate trends last year come down in some categories. And certainly if you look at high yield and corporate, because those spreads came down last year, that added to the price performance. And so we're not necessarily expecting a lot of that this year.
All right, so from a return perspective, everything we've discussed so far is for the quarter, or at least looking back maybe over a 1-year period. But there's been a lot of change, Jonathan, since March 31 and the quarter end. So what we're showing here then is kind of the volatility that we've experienced, because these numbers that are up now are the March monthly numbers for each of these equity sectors. And you can see March was not friendly to any of these equity categories, down, 4 to 13%. But you had made reference to the snapback. Month to date in April, and this was as of, I think, the 14th, you can basically flip those in to positive from negative. So, up anywhere from 5 to looks like 12%. That's an amazing recovery. And just in the last day or two, several components of the market have hit all-time highs. So we came into the year really strong at almost all-time highs. We had a fair pullback. I wouldn't say it was really a significant pullback, but a pretty good pullback. And now this snapback, it's pretty astonishing given all the geopolitical issues. And the economic data is good, don't get me wrong. Like all that data we talked about on the dashboard, Jonathan, it's good. But I don't know. I mean, it's hard to explain the snapback, that being that quick.
Yeah, absolutely. It is surprising, I think, to a lot of people.
And I guess testament to why we don't try to time the markets. I mean, if we look back to last year, Liberation Day, we have that massive pullback, which we're going to talk about in a few minutes, from Liberation Day. And I remember, like, sentiment was super negative. People were questioning, do they need to get out of equities? Is this the start of like something really, really bad in the markets and the economy? And we ended positive. March was the same way this year, pretty negative. People were wondering what's going on, and yet another snapback. Now there could be another pullback. I mean, that's typical. Sure. But this is just testament to don't try to time the markets. We saw a little bit of the same as it relates to more of the bond market. So March obviously wasn't all that friendly in bonds, and yet year to date we're seeing more positive performance there, pretty much across the bonds. Commodities, one exception.
Yeah, we've seen oil prices come down, so that largely.
I mean, they got driven up a lot because of the activity overseas. All right, so with that, let's talk about SilverOak's outlook and what we foresee in the future. And I guess we've touched on these, Jonathan. The later disappointing AI productivity benefits, all this, trillions of dollars have gone in. Are they going to get the advantages that they thought they would from that? Consumer spending is obviously 2/3 of the economy. Is that going to slow down? Consumer sentiment's terrible, like terrible. But do you care what consumers say they're doing?
It should have a bit of a correlation to spending, but we haven't necessarily seen it.
We haven't seen it, no.
So
yeah, I mean, I care what they do, not what they say, right? Like, look at the numbers. But there could be a slowdown there. That's something that we want to be mindful of. Inflation, maybe we're going to see some unexpected increase there. Labor markets could further weaken, and especially as a result of AI. I mean, these are all things that we're watching out for, that we're monitoring, but they're not new, right?
Nope.
I think if we look back, they were on the last
slide deck for last quarter.
But you know what we weren't talking about this time last quarter? This one.
Yeah, it was a complete surprise. I mean, if you think back, a long time now, but as we turned into the year, no one thought of Venezuela.
Right.
And then Iran wasn't even on people's list of real risks.
Yeah. So it just speaks to the fact that we can do all our planning, and we do our planning. I mean, it's important to do it. But there can be these other factors that just really aren't even considered black swans at the time, but they become black swans. But the other thing it points to is, and we're going to talk about, even something like a war can have pretty negligible impact, and certainly not long-lasting impact on the markets.
Yeah. So I'll talk about this slide. We're calling it a meaningful narrative shift. So in the last month, really all of the discussion has been on oil and how that could cause inflation to go higher. We've heard kind of headlines that oil could go to $150 a barrel. So we were stable economically going into Iran. And so what we saw in March with the pullback in the markets, that reflected the uncertainty. And so to a certain extent, some of the other risks that we highlighted that are also on this slide are a bit more back burner now. We're still kind of watching the Iran situation.
Got it. All right. Let's make sure we go the right direction there. How about on the economy? What's our outlook there?
So basically, the backdrop likely is intact. We've talked about all the kind of positive cases, tax refunds, the ongoing infrastructure and AI spending, the wealth effect that we've seen from stronger markets fueling consumer spending, kind of in that K-shaped economy standpoint. You know, and a ceasefire could likely cause oil prices to fall. Now, I put this together early in the week. And, you know, if you followed it, you know, oil prices took another shift down today. But outside of that, even, we thought that we could start to see inflation moderate in the second half of the year. And one of those factors that is driving that is shelter costs are finally starting to come down.
Good point. Good point. What about the Fed?
You know, the Fed has basically been on hold now for a number of months and likely continues. Now, the thought process is that there would be one more cut this year. But I think with oil prices up, with Iran still not at conclusion necessarily, I think the earliest the Fed would look at cutting would be later in the year.
All right, internationally, anything you want to touch on there?
You know, I think the issue here is that Europe, Asia look good going into the year. Now, they get more of their oil from the Middle East and other countries, so they are a bit more affected by what's going on in the Middle East. And so if it becomes a longer conflict, it will definitely raise their prices. You know, you maybe saw the headline that Europe, in terms of jet fuel, they might be only having a week.
They might have to cancel some flights.
Right.
And
so though, if that comes to, pass, that will be a bit more of a disruption.
Got it. Talking about energy.
Yeah, so we wanted to kind of show where oil stands, say, in the global economy versus where it was. And so if we look on the left side of the slide, this is looking at energy intensity, meaning how much energy for each output of GDP does it take? And you'll see the different countries, but if you look, you'll see the world since 1990 is down 33% in terms of economic activity. It just takes less oil to generate economic growth. And in the US, it's down a full 50%. And so while oil demand has definitely grown during that period, the economies have grown even faster. So that intensity is down. And then if we look on the right side, we're really looking at the US and our situation with oil. So if we look back to the early 2000s, we were actually importing more than 12 million barrels a day. And then if we look at our current situation, we're actually exporting, 2.5 million to 3 million barrels. So a very, very big swing.
Mm-hmm.
And so we're just a bit less dependent on Middle East oil as a result.
And I think that's a very fair comment. I always get the comment back though that, it is a world market, right? And oil is priced in this world market. We're not necessarily insulated from these higher prices completely anyway, certainly more so than in the past. But even there, the prices weren't or didn't get that. I mean, they got high, don't get me wrong, but not that high.
Yeah, I would say part of the issue might be that if we look at on the far right, December 16th, so near the end of the year, oil was trading below $60 a barrel. The markets were well supplied with oil, production was rising, and so the price was relatively low. And we have seen a spike, and so it did spike to over $100 at the end of the quarter. But if we put that price in perspective and consider that the Strait of Hormuz being closed is one of the biggest dislocations for 20% of the oil supply of the country, of the world,
Yeah.
where are we for that sort of big disruption versus other peaks in oil? And so you'll see in 2022, oil reached $124 dollars a barrel. But even if we go back to 2008, where we did see another big spike in oil, it's at $145. But if you take that 2008 price and adjust it for inflation, we're talking about much higher prices, between $180 to $200 a barrel. And this morning, we don't know whether it will hold at these levels. Oil's down to about $90 a barrel. So far less than what the impact was even 20 years ago.
So as far as our outlook on how this all impacts the equity markets, what would you say?
I would say that the recent recovery seems to be the market's view that the administration is seeking an off-ramp, and that they keep on assuring people that we're almost done. And so I think that is what the market is projecting. And so to a certain extent, if the war does go longer and there are more disruptions, again, we could see a pullback. You mentioned we could see another pullback, and that's entirely possible because it is a midterm election year, and that can happen late in the summer and the falls of midterm election years. I think another thing that we listed is evident. We're going to likely see higher volatility this year.
Yeah.
So
and that that volatility is not necessarily bad, right? For investors that stay invested, that don't try and time the markets, that volatility is noise, just kind of static in the air. It's those investors that really try and trade around those events that can have significant negative impacts on their portfolio. So this is a little framework based on what maybe our base case is with regards to the war.
Yeah, so if we look at the April secession scenario, meaning a quick war, which seems to be more likely, and that's certainly what the market is reflecting, then we've probably seen our lows for the year. Again, maybe some volatility.
Or at least lows for the year relative to this event. Who knows what the future has.
That's very, very true. But I think, the second issue really would be that in the second scenario, where this takes longer and goes into the summer, if we look at the equity response, we could go lower. And in this case, it could be a bear market. Now, we don't know.
Right.
But that's certainly a possibility. But the longer the conflict goes, the higher likelihood that there's an inflationary shock because consumer expectations reset.
You got it. Yeah. Well, and I even somewhat hesitate showing this slide here, only because I don't want to minimize the impact that wars have from a human perspective, because they're terrible, right? I mean, people's lives are disrupted and some are even lost. But what we're seeing here, Jonathan, is just simply from a financial perspective, from a market perspective, I guess even more specifically, they don't really have much long-lasting impact, do they?
No. And in fact, in many ways, now this is early days, it's, half a month. The 1 month recovery is already higher than what the historical average is. And again, that could change. But generally, the reason that they're short-term in impact is that they just generally have not had an impact on the business cycle.
Yes. Yeah, that's a very fair point. Well, the other thing that we've touched on a little bit already, but this is one of my favorite slides of all time. This and the quilt chart, which maybe we can show in the next session or the one after. But this slide shows, and I know there's a lot of numbers, and don't get too caught up in this. Just focus really on two components. I think they're red dots, the red dots.
Yep.
The red dots signify the intra-year low for that particular year, and every year is in a different column, or think of it as columnar. And then the blue bar is the year ending performance. And this is all for the S&P 500. And the point being is, it is not at all uncommon for us to have intra-year lows in the 10%, even 15% range is not all that uncommon. And yet, the majority of the time, regardless of the level of the intra-year low, the market actually ended the year positive. And again, it kind of speaks back to 2025. Like, if I would have polled investors at the end of April of 25 to say, do you think we're going to have a double-digit return year? I think the probability would be like nobody would have answered yes. Right. Yet that's exactly what happened. And this year we haven't had that big of an intra-year low, maybe more, but it doesn't necessarily dictate that the year as a whole has to be negative. And I don't know, I just love this, because it really speaks to the fact that we really have to be careful and not try and time the markets. All right. With that, let's touch back on earnings, because there's an interesting thing going on right now with earnings estimates.
Yeah, we've talked about this in the past. Earnings estimates typically are at the highest when you start the year, and then as you go through the year, they tend to come back down to reality. This year, though, we've actually seen them go up. And so right now for 2026, the estimate is that earnings will grow at a 17% rate. That's up 2 to 4% higher than where we started the year. And then again, next year, they're looking for 16% growth. We've talked about valuations in the market being high. They can remain high, but if you have that earnings growth, that kind of fuels the market and also provides that backstop.
Yeah, I mean, that's the thing why valuations are like the worst tool to use to predict future performance, because valuations can stay high for a long time, and a lot of that, as you point out here, is the earnings.
If we look on the right side, despite tariffs, fourth quarter margins were actually at records.
Yeah.
And now with the Supreme Court ruling, companies are going to get some of that money back. So,
Oh my gosh. Oh, a lot of interesting circumstance here. Bonds. We talked about bonds being good last year. Had kind of a rough first quarter along with stocks, obviously not nearly as rough as stocks, but and then they've made a little bit of a comeback as stocks have. Where do we think the bond market or fixed income is gonna be?
you know, yields are attractive, and we've also talked about how yields tend to set kind of the return. So again, this year is probably a year where yields will be more or less the return. Risk reward is favorable, again, because of this higher yield. We've talked about this and it kind of remains the same, but municipal bonds are relatively attractive. Their treasury yields are not that dissimilar, but you get that tax benefit. And then, in a year with equity volatility, we do think that current yield offsets that volatility. We talked about it, earlier, but, rate cuts are going to be pretty modest. There's been some chatter about, could we actually see rate hikes? Probably not.
Agreed.
But again, probably the soonest we could see the Fed cut rates, and that would be likely a quarter point, would be later in the fall, if not closer to year end.
Yeah. Well, let's see what even happens with the Fed and
Right.
the appointment of the new chair. And
right.
I mean, that's a whole story in and of itself. All right. Well, great job with going through all that. The Fed interest rates. I think we've kind of touched on this a couple of times already. Anything else you want to?
Yeah. The only thing, if you look on the far right, is that again we're seeing a flattening in that rate cut, and that is based on the Fed outlook, and the market outlook is actually a little higher than where the Fed is, and so you could argue the market is actually expecting a little less than one rate cut.
Yeah.
So,
well, thank you for a flurry of just great information. Appreciate all that data. Let's now transition into our topic around financial planning for incapacity. And again, this is situations where we have a loved one that has become incapacitated, Alzheimer's, dementia, or some other condition that has impacted their abilities. Why is this important? Why does it matter, Jonathan?
Because the best time to deal with it is before it happens.
Yeah, that's fair. Yeah.
So,
yeah. I mean, and it can impact anybody. I don't care if you're worth hundreds of millions of dollars or if you're just trying to make it paycheck to paycheck. This can impact anyone, and it impacts your loved ones even more than it does you many times, not to minimize it. I mean, I would never want to be in that situation, but your loved ones, really, those that are closest to you, are like living it like every day with you in a different capacity, but it really is, it just changes lives.
I think the other challenge is it can be very gradual.
Yeah.
And when you're living in that moment, you're not necessarily seeing the change.
That's fair. Yeah. Yeah, that's fair. I know, individuals that I maybe see once every 3 months or every 4 months or so. I can see it as I meet with individuals, like, oh, but you don't know. Well, maybe it's just a bad day. I mean, we all have bad days. Some days we're on, some days we're off. But yeah, you're right. Like if you're living with somebody day after day, you just either don't see it because it's so gradual, or you want to not believe it.
Right.
I see that a lot as well. So what do we do from a planning perspective before incapacity. And I'm not talking about like, hey, some 20 or 30-year-olds got to start thinking about this. This is, I don't know. Let's say I mean, it can impact anybody. I understand that. But let's say, you're in your 60s or maybe 70s and, you live a great life, but you're worried maybe, maybe you might be impacted by this. What do you do?
Well, first you want to have a conversation with the person.
Yeah.
And just understand kind of what they want to do. Do they want to stay in the house? Do they want to go to a facility where they could get more care? Do they start with home health care first to see how that works and then progress? Many facilities have years-long wait lists. And so again, that's where the planning can help. And of course, just understanding kind of end-of-life care and what the people's wishes are.
Yes. Yeah.
And then really, it's documenting who are the key people in the person's life, financial life, recognizing fiduciaries, who they are and when they might need to step in. Really critical in that would be with all the financial institutions, registering a trusted contact so that they can call somebody if something is happening. But also just really important is establishing power of attorneys and or successor trustees for trusts. And really that breaks down also into somebody for healthcare matters, somebody for the financial matters. And we've started to talk about this internally recently, is having a representative payee set up for Social Security.
Yeah, because that's amazing. This is something, it still is unbelievable to me that Social Security, who deals with this age group, right? I mean, you can't take Social Security till you're at least 62. So you're dealing with the older population. Social Security does not recognize power of attorneys. So you might think you have everything in order, you got your power of attorney, et cetera, but if you have an issue with Social Security and you're not able to communicate with them directly yourself, there is like no hope. If you haven't set up a representative payee, it is virtually impossible to communicate with Social Security. And that just still astonishes me. What other things do we need to think about before incapacity?
Organizing. So key documents, the legal documents, estates, title and deeds, beneficiary designations, birth certificates, Social Security card, things like that. And then of course, financial documents, knowing where their money is, the bank accounts, investment accounts, retirement accounts, pension and Social Security information, as well as insurance policies. Maybe not as big of an issue currently, but digital assets. But I think over time, that's going to be a bigger issue. But also really, really key is communicating with the people who would step in, where the documents are stored, where the online account information is stored, and the passwords. So if they have to spring into action, they can actually do it.
Yeah, very, very good point. And you had made reference to estate documents. So obviously reviewing those.
Yep, you want to review them because there might be changes. They might be 20 years old. And so you just want to make sure, again, when you've had that conversation, that they are up to date and reflect the.
So once you lose capacity, you lose the ability to change these documents.
Correct.
It becomes very, very difficult, if not impossible.
Yep. And also, importantly, you might need to talk to an elder care attorney if there's a financial issue in terms of protecting assets, and Medicaid might become an issue.
Good point. What other things, again, all yet here before incapacity, what other things to
Reducing the number of accounts and credit cards. You don't want 20 accounts in 20 different financial institutions. You want to review your insurance benefits, meaning is there long-term care insurance? When does it kick in? What is the dollar per month? And that goes into planning and understanding what the care costs are, creating that budget. And then through all of this, it's really communicating with family members and the other people who would step in, schedule those regular check-ins.
Then once incapacity occurs, and things really change with that, because now the individual no longer has a legal position to make these decisions on their own, and the fiduciaries are stepping in to make these decisions. So once, and some of this, Jonathan, I know you're well aware of this, there's kind of a blurred line between, it's not like, oh, you're all the pre-incapacity things, and then you're at the incapacity and all these other things happen. There's a little gray area, it's sometimes a really big gray area, where these things happen kind of coincidentally or with each other. But, you know, setting up direct deposits, like that's one. Like if you really know somebody's going to become incapacitated, maybe you do it before. But if it's a really slow progression, maybe that doesn't happen because the person's not willing to give it up. But setting up automatic bill pay, you know, tracking the budget, aligning the portfolio, this is a big one, right? Because you mentioned the cost. The costs might skyrocket, and a portfolio that wasn't really designed to generate a lot of liquidity now has to be shifted to accommodate that liquidity. Planning for RMDs, required minimum distributions, if the individual has IRAs or 401ks, you know, those are required, like the name implies.
With hefty penalties.
With hefty penalties, and just because you're incapacitated doesn't like mean that those tax laws don't apply to you anymore. Paying taxes, like just, you know, just practical, like things that maybe don't happen every day, but they're super important. Just thinking about those things and having a plan of action. You know, establish safeguards, you know, contact the insurance companies and remove the person that's incapacitated from the car. Now, don't do that if you're worried that they're going to go out and get in the car and drive off. And I've had several, you know, circumstances where that's been a concern. So don't drop the insurance until you know the person literally physically cannot have access to the car. You know, adjust mailings, adjust who's receiving financial statements, review those financial statements very, very closely. Set up alerts for withdrawals, or if account balances get to a certain level or lower, that you get notified, or somebody as a fiduciary gets notified. And maybe have financial institutions put on hold accounts if there's, you know, concern. A couple other things, lower limits on credit cards. I mean, unfortunately, I've seen it many, many, many times. Someone losing their capacity, they start to live in a very, very small world, and they have a lot of interaction with people outside electronically, like on their phones and emails. And all of a sudden, you know, they're buying a whole bunch of stuff, or they're subscribing, or a big one that I've seen is they start donating to different political causes. Like maybe they'd done $100 in the past, but now they're doing like thousands and thousands of dollars. So be very, very mindful of all of these types of issues. And then there's non-financial safeguards you got to think about too. Like, you know, I always think of it in a perspective of if they're going to live at home, and to your point, you know, have doctors or have nurses or have care provided at home, you need to child-proof that home. You need to prepare that home for a situation that maybe, you know, it's been 30, 40, 50 years since you've had to think about some of these things. You know, installing outlet covers, anchoring heavy furniture, limiting access to, sharp objects, chemicals, medications, lowering, this is a big one, lowering the water heater so that they can't scald themselves. Installing door alarms so they can't leave at night, just walk out of the house and you're not sure where they went. Maybe putting GPS trackers in their clothes. I mean, some of this, it seems like a little bit over the top, but these are serious circumstances. And I've had more than once a client in this condition, unfortunately, who's left the house and literally the family's had to call the police to file a missing person, and there's been a search to find them. I would take it very seriously sooner than you think, because usually people wait a little bit too long for some of these items. And then, as Jonathan mentioned, communication and check-ins. Like with anything, communication. Okay, and utilizing the support services. A lot of folks, especially the spouses of individuals that are in this condition, they feel a little bit isolated, a little bit maybe embarrassed, but don't be. There's thousands, tens of thousands, hundreds of thousands of people that are going through this. You are definitely not alone. So with that, Jonathan, concluding the incapacity discussion, what would you say?
The best time to plan is before it's needed.
So you started with that and you're going to end with that.
Have the plan in place.
I like it. I like it.
Having clarity will reduce conflict and uncertainty. So have clear roles, document everything, organize the information, monitor on an ongoing basis.
Yeah.
And it's an ongoing process, so things will change, and your plan has to be flexible enough to evolve as needed.
Yeah, all great points. Well, let's go through here in the last couple minutes SilverOak update. So we have had quite a few adjustments in our IQs, our investment quality scoring system. We've had one position removed from the recommended list. 2 positions were added to the recommended list, and we have 2 positions added to the watch list. So anything like more on any of that?
Yeah, what I would say is the 2 positions added to the recommended list were ETFs that were mirroring 2 existing funds that we utilize. And so certainly an ETF is a bit more tax efficient, so that made sense. 2 positions, to the watch list. One of the things we talked about, was that the fixed income situation was fairly stable. But one of the things that has come out as a concern in the last few months is private credit.
Right.
And so did want to highlight, that there is concern. There have been articles about that. We've not seen a change in our existing investment, but we are monitoring the situation as a result.
So we have a private credit. Not all of our clients are in it. As a matter of fact, I would say a minority of our clients are in it. We put it in particular circumstances. Again, all of our portfolios tend to be customized based on circumstances. But we've been in communication with that team. We're comfortable with the overall strategy that they have, but I think the one concern that we have kind of going forward is the liquidity, like the redemption cycle, and is that going to have a negative impact? Our investment committee is meeting regularly to discuss this, and the next redemption cycle for this particular strategy, it's a quarterly redemption, is June 30. So we'll be communicating with our impacted clients prior to June 30. With regards to what our recommendations will be, either to stay the course and continue to monitor as we always do anyway, or if we want to make any slight adjustments. But I'm glad you mentioned that one. And I will also mention the one position that was removed from the recommended list. That was a position just wasn't highly utilized, so we just didn't have a lot of assets in it. Other SilverOak updates. Our build out, I think, is actually, it says in progress as of as of maybe yesterday, the day before, it's done. So that's exciting news. I guess we do have some extra workstations that are being installed yet. We've got several technology projects for the summer now that tax season's over, including an AI project that I'm super excited about. We've also hired 3 new team members, 2 in financial planning on our financial planning team and 1 in our portfolio management team for trading. So that's great. We are still looking for 2 more team members, 1 in our operations area and 1 more as a finance manager role. So those are outstanding, but hopefully will be filled here shortly. So with that, Jonathan, again, thank you for all of the great comments and all the effort going into this, and for the rest of the team putting their efforts into it. And thank you everyone who attended. We certainly appreciate you taking the time to do so. We value your time greatly. And if you have any follow-up questions or even suggestions for future topics that you would like us to discuss, reach out to your SilverOak advisor, or feel free to contact me here at 952-896-5701. With that, have a great day.
Thank you, everyone.